Good morning. My name is Vince Lancy. This is the Goldfix Market Rundown. The last two trading days have been revealing in terms of who now controls the gold market, at least currently. Several days ago, with gold down $100 from its highs, concerns of an overbought market began circulating. These coincided with upcoming Asian holidays. Backtesting models, particularly those used by macro discretionary funds, suggested that following such a down move, gold tends to decline over the next 2 months. The specifics of that analysis are detailed in our recent backtest post. We will include that. Leading into the holiday period, before the China May holiday period, it became evident over a 4-day stretch that significant buying emerged in what we identified as the ledge area following the steep sell-off. Just beneath that zone, we continue to believe physical buying, likely tied to Chinese demand, remained intact. As the holiday did approach, large funds, emboldened by statistical models, began initiating short positions. However, the physical buying held firm, keeping the market in a defined range, wide, but defined nonetheless. The ledge then broke temporarily. On Thursday, the ledge appeared to crack. Singapore-based speculators, really Shanghai-based speculators, liquidated ahead of the holiday. Futures traders who had accumulated positions during Asian hours over several days exited en masse. U.S. macro discretionary funds and CTAs, U.S. CTAs, followed with their own models that signals initiating further selling. By Friday, with China largely offline, the market remained below the ledge and in a bearish posture. Still, it didn't break further. Prices hovered just below the zone we identified as the focus, or locus, I should say, of the real physical demand. The key question going into the next session was, meaning Monday's session was, starting Sunday night, was whether futures-based speculators would return Sunday evening. They did, tentatively, but enough to keep the market stable and even slightly positive. That uptick appeared to spook financial players in European hours, and the rally continued throughout the day during USA trading. By Monday evening, with Asia fully open, as we can see on the screen right here, Shanghai traders returned aggressively. As in past episodes, these are futures-based speculators, momentum-driven, well-capitalized, and well-informed. Though technically independent, they operate with full awareness of and sometimes alignment with Beijing and its proxy institutions. The market advanced sharply, I should say. As of now, gold is up $42 and change, having been up $50 about an hour ago. Which brings us to the core question. Considering that when Asia was open, the market was higher, and when Asia was closed, the market was somewhat lower, and now Asia is open again, and the market is over $140 off the low. The question is, who controls gold pricing now? Can there be any doubt that the pricing power in global gold markets has shifted eastward? Can there be any doubt that in time, gold will begin appearing priced in yuan on trading screens? Can there be any doubt that we're witnessing the erosion of US dollar dominance in gold as pricing migrates eastward, following the physical industry, which has been relocating for over a decade? Finally, can there be any doubt that the US is no longer holding sole control and must now share the stage? Goldman knows this as well. Now, we're not fans of Goldman as traders, but as analysts, we understand their work and appreciate it very much. They seem to recognize this. They've been bullish for the last $1,000 of this rally. Whether one trades with them, against them, or ignores them, they've been correct, which brings us to the second key point. Goldman's Sunday night note. In it, Goldman reiterated their bullish stance on gold remarkably during the rally. More notably, they stated they expected gold to outperform silver in the coming months and laid out their rationale. We neither endorse nor dispute their view here. We simply note it, and we will cover it in a minute. An excerpt of that report is